Good day, I'm Rob Tatro from robtatro.com. Today we're talking about real estate investment trusts, otherwise known as REITs, R-E-I-T. So a REIT is effectively ownership of a bunch of different parcels of real estate that is managed by a company. And generally, the publicly traded ones, they trade on an exchange. So in Canada, they trade on the TSX. Now there's also some private REITs which don't trade, and they're actually structured usually as a limited partnership or something like that. But the idea is pretty simple. I want to own real estate, you want to own real estate, everyone wants to own real estate because it's a fantastic performing asset class. It's got usually less correlated to stock market performance. It provides ridiculously efficient, tax efficient income, and it appreciates over time. So it's something that I think most people would agree that they want to own. The problem is we all can't go out and buy a bunch of different shopping malls, and we can't just go out and buy a bunch of different apartment blocks. So we wanted, in the early 2000s, they wanted a way to change this. So the advent of REITs came along, early 2000s. So, about 15, 20 years ago, they started popping up. And at first it was a pretty novel concept, and they got a huge traction, and it became very, very popular. Now, what we've seen lately is, they've come down a bit, and there's likely some opportunities at some point for every Canadian to own a publicly traded REIT. Now, why? Why would someone want to own that asset class? Well, the main reason that I really, really like it, especially in non-registered accounts, is the taxability of it. You get what's called return of capital, which is classified as non-taxable income. It's ROC. We call it ROC. In my vernacular here at the office, we call it ROC. ROC is not taxable. It's classified as return of capital. So you get to depreciate the value of the building against the actual income that's being collected. So you have a landlord, you put some tenants in there, you collect the rent, you pay down the mortgage, the rest is effectively distributions to the unit holders. Two things happen also at the same time. One is you're paying down your mortgage over time, you're paying down your debt that exists on that piece of that parcel of property. And two, you hope to get some growth over time in the actual value of the building that you bought, because you are an owner of real estate. When you own a REIT, you're a shareholder in a trust that owns a bunch of different office buildings, or a bunch of different apartment buildings, or a bunch of different commercial buildings. And that's the other neat thing about REITs, is they can get very, very specific, or they can get very, very focused, or they can be general. You can get an apartment REIT, you can get a commercial REIT, you can get an office REIT, you can get a industrial REIT. There's a whole bunch of different categories that exist based on the different needs that people want for investing. So you get tax-free and tax-efficient income, fantastic for non-registered accounts, for corporate accounts as well. So very, very tax-efficient. Generally, studies have shown that it can be uncorrelated to performance of the stock market. And the other good thing is it's fantastic for long-term growth and long-term stability of a portfolio. So it makes sense for a lot of people. It could make sense for you if you believe in real estate, if you're the type that always wanted to own an apartment block by yourself, or maybe you already own an apartment block but you want some separately managed assets that are managed at, well, a good way to do that is through a REIT, a real estate investment trust. It could make a lot of sense for you, and it's very, very tax efficient. I'm Rob Tatro from robtatro.com. Thanks for checking in today. Thanks for tuning in. If you like what you see, subscribe to our YouTube channel. You get notified every time there's a new video. Otherwise, put your comments below, share, and like. Thanks so much.